pressed buy. The stock dropped 40% in 3 weeks. And the worst part? It wasn't bad luck. It wasn't bad timing. It was your brain. Specifically, it was a set of invisible mental traps that Wall Street, casino designers, and even your own evolution built into your decision-making. And right now, those traps are costing everyday investors thousands of dollars every single year without them ever realizing it. In the next 8 minutes, I'm going to show you exactly which psychological biases are quietly destroying your returns, and more importantly, how to actually fight back against them. But first, I need to tell you about a man named Richard. Richard is a 28-year-old guy who started investing in 2018. He did everything right at first. He read the books, he watched the videos, he diversified. But in March 2020, when COVID hit and markets collapsed, Richard panicked and sold everything. Then the market bounced back faster than almost anyone predicted. Richard watched from the sidelines as his former portfolio recovered and then hit all-time highs. He lost around 35% of his potential gains, not because the market beat him, but because his psychology did. Richard isn't a cautionary tale. Richard is statistically the average investor. And unless you understand what happened inside his brain, you're already walking the same path. Here's the first bias you need to know. It's called loss aversion. Studies by psychologists Daniel Kahneman and Amos Tversky found that losing money feels roughly twice as painful as gaining the same amount feels good. Think about that. If you gain $100, you feel a certain level of happiness. But if you lose $100, you feel about double that pain. This is why Richard sold. His brain wasn't doing math, it was doing survival. The same ancient wiring that told your ancestors to run from predators is now screaming at you to sell when your portfolio goes red. Evolution didn't prepare us for the stock market, and that mismatch is costing us everything. Now let's talk about the second trap, one that's even sneakier. It's called FOMO investing, driven by a bias called herding. When everyone around you is talking about a stock, a coin, or an asset, your brain registers social proof as safety. If the whole group is moving this direction, it must be the right direction. Remember when everyone was piling into crypto in late 2021, or meme stocks, or NFTs? Millions of beginners bought at the absolute peak because the noise was loudest right when the opportunity was actually smallest. The herd mentality feels like wisdom because it's shared. But in investing, by the time everyone's talking about it, the smart money has usually already moved on. Here's one that fools even experienced investors. It's called anchoring bias. Anchoring is when your brain latches onto the first number it sees and uses it as a reference point for everything after. Say you buy a stock at $200. It drops to $120. Your brain says, it's still cheap, it was $200. But that $200 number is completely meaningless to the market. The market doesn't care what you paid. Anchoring makes us hold losing positions way too long because we're waiting to get back to even. That mental anchor isn't a strategy, it's a trap. And it's one of the biggest reasons investors ride bad positions all the way to the bottom instead of cutting their losses early. Bias number 4 is confirmation bias. And this one is honestly the most dangerous because it feels like research. Confirmation bias is when you seek out information that supports what you already believe and unconsciously ignore everything that contradicts it. You buy a stock. Then you spend 2 hours reading bullish Reddit threads and YouTube videos about why it's going to the moon. Meanwhile, there's a perfectly credible analyst saying it's overvalued, but you scroll right past that. You're not researching, you're reassuring yourself. Real investing requires you to actively look for the reasons you might be wrong. That's uncomfortable. But that discomfort is literally what separates profitable investors from everyone else. So why do all these biases exist in the first place? Daniel Kahneman wrote about this in his book, Thinking Fast and Slow. He describes 2 systems in your brain. System 1 is fast, emotional, and automatic. System 2 is slow, deliberate, and logical. When you're investing, System 1 is running the show most of the time. It sees red and screams sell. It sees everyone buying and screams buy. It makes decisions in milliseconds based on feelings, not fundamentals. The entire goal of investor psychology is to build habits and structures that force System 2 into the driver's seat, and the good news is that's actually learnable. Here's how you start. Strategy 1. Write it down before you buy. Before you invest in anything, write down exactly why you're buying it, what your target return is, and the specific conditions under which you'll sell. This sounds simple, but it destroys multiple biases at once. It forces System 2 to engage before emotion takes over. It gives you a logical framework to return to when panic hits, and it prevents you from constantly moving the goalposts after the fact. Warren Buffett doesn't invest based on vibes. He has a written thesis for every major position. You should too. Even a messy journal entry is infinitely more powerful than trusting your gut in a volatile market. Strategy 2. Reduce the noise and create distance. The more you check your portfolio, the more you trade. The more you trade emotionally, the worse your returns. Studies show that investors who check their portfolios daily significantly underperform those who check monthly or quarterly. Turn off real-time alerts. Unsubscribe from the daily market panic email. Schedule a monthly or quarterly review and stick to it. This isn't ignoring your money. It's protecting your money from the most dangerous threat it faces, which is you acting impulsively on short-term noise. Distance creates discipline, and discipline, not intelligence, is the actual edge most successful long-term investors have over the crowd. Here's the truth that nobody tells beginners. The biggest returns in investing don't come from finding the hottest stock or timing the perfect entry. They come from understanding yourself well enough to stay rational when everyone around you is losing their mind. Richard eventually came back. He learned about these biases. He built a simple rules-based system. He stopped checking his phone every hour. And over the next 3 years, he quietly built real wealth while most of his friends chased hype cycles and got burned. Your psychology is either your biggest liability or your greatest competitive advantage. The difference is awareness. And you just got some. If this gave you a new way of thinking about investing, the next video on behavioral finance is right over there. I think you'll find it worth your time.